there's a lot of things going on right now. We got a new president. There's a lot of interesting headlines. How do you cut through the noise and just stay focused on what you know to be the tried and true investment approach?
It's experience, having lived this, having done this for so many years. There's investing, there's gambling, and there's speculating. And think about gambling, you know your odds. With speculating, you don't. There are no odds. So a lot of people that are day trading, it's speculation. It is the riskiest thing you can do.
So for someone that is young, I would say that the keys to build wealth are some sort of tried and true investment strategy. And probably as more important is... Hi, I'm Zach Majors, the CEO and co-founder of Centric Wealth. And I'm here today with our Chief Investment Officer, Richard Cull. Richard, say hello to the people out there.
Hello, people out there.
We got a great show, I think, planned up for you today. We're going to be talking about a lot of things investment related, what's going on in the markets, what the future of wealth management holds. And before we do that, I would like to just take an opportunity for Richard to give a better introduction of himself and a little bit about your educational background and what you do here at the firm at Centric, and then we'll go from there.
Okay, thank you, Zach. As you said, I'm the Chief Investment Officer. Have 30 years of experience in the industry as an investment analyst and a portfolio manager. I'm from Houston. I got my master's degree from Houston. I went into the Army from Houston, and I'm a diehard Cougar fan and Texan fan.
So, Richard, in your job, what is your main responsibility in the things that you do?
Basically twofold. I am an investment analyst and a portfolio manager. So when you start out in this business, you start out as an investment analyst. So you look at specific investments and you analyze what they're worth and what you think they're going to be worth. And then above that is the portfolio manager. And the portfolio manager normally will have a stable of investment analysts who listens to the analyst tell them, and then the portfolio manager will construct a collection, a portfolio, if you will, of the different securities to match whatever the investor's goals are.
Yeah, okay. So in Europe, there's a lot of things that's going on right now. We got a new president that's going to be taking office here in the next couple weeks. A lot of interesting things, a lot of interesting headlines. How do you cut through the noise and just stay focused on what you know to be the tried and true investment approach?
That's a very good question. And really it's experience. It's having lived this, having done this for so many years. When I started out and I got my undergraduate at Southwest Texas State, which is now Texas State, and I was hired by a firm in Kerrville to manage institutional portfolios. And it was my responsibility at the beginning of the day to go in and read all of the financial news before the market opened at 8:30, and then to sit down with one of the partners and say, this is what happened. And then after a while, he would say, well, what does that mean for us? What does that mean for our clients? And so that was a very good introduction. And that was the beginning of the day. And then the rest of the day, I would analyze investments. And I had to read the Wall Street Journal. I had to read Barron's. I had to read the New York Times, in addition to just reams of research. And the purpose of that was to find out how other people analyzed what I had just read. So not that you want to think like they do, but you have to know how they're going to think. So that was an education, and I know I'm getting off the subject here, but over the years, you're able to see something and say, okay, that's, the same thing that was rolled out 20 years ago. It's just a new package, new packaging, new marketing.
Right.
And that is a lot of what's going on today. I think the internet makes it more prevalent because it used to be harder to roll out a new product. So you had your Merrill Lynch's and your Morgan Stanley's, and they would invent a product and they would roll it out, and they would They would have to call their clients, or they would cold call people and say, let me send you a one-pager in the mail. And so it would take a while. But nowadays they can disseminate on YouTube, CNBC, whatever, and say, hey, we've got this great new product. So we're inundated, but my experience allows me to look at it fairly quickly, say, this is an old product, or this truly is a new product.
Right.
And then that's the investment analyst hat, because then you have to dig in and say, does this do something that our other securities doesn't do, won't do? And could this benefit us? And should we add it to the portfolio?
So when you're growing up in the business, you get online, you check the various news sources, or read the paper, and now the news sources are completely different. Most of especially the younger generation, they're consuming all their news from YouTube, financial news from YouTube, from TikTok, from Twitter, and then maybe they go to Yahoo Finance, they see the sponsored ads that hit them first. Like, how do you sort through all of that? And then what advice would you say to a young person that is trying to, that typically will come into our office and say, hey, this is what I heard that we should be doing for finance or to build my investment portfolio. How do you cut through all the various information that can really become overwhelming and just stick to what is tried and true, what is going to help build wealth, what is going to help someone's investment portfolio?
Yeah, it's another good question. And we've thought about this a lot. And when I got into the business in the early 90s, there was not much information available to the public. So I was able to get Wall Street research because we were managing close to $1 billion. So I got the research from Oppenheimer and Merrill Lynch and whomever else. So I could read these experts. And then, like I said, just the general financial media. Nowadays, it's the exact opposite. It is too much. It's coming at you like a fire hose. And there's too much, so you have to be an expert at parsing through what should I pay attention to. So I have Bloomberg TV on all day. It used to be CNBC, but I have it muted. Because frankly, I don't want to hear what they're saying. I keep it on in case there's some breaking news, even though I'm sitting in front of my terminal. And getting back to what you said, when I first got in, it was all out of the Wall Street Journal, out of print.
Mm-hmm.
So nowadays, I've had a couple of interns, and most of them are overwhelmed, as you can imagine. They ask me, who should I listen to? What should I read? What should I watch? Because unfortunately, at first, in the late 90s, this was very beneficial for people to all of a sudden hear from the CEOs coming on television and from these prominent analysts. But then it became about entertainment value. Mm-hmm. And Jim Cramer.
Right, smashing stuff with hammers.
Exactly. And investing is very boring to most people. I mean, to me, it's very interesting, but to most people, it's very boring.
Right.
So how do you get people to tune in to CNBC or Bloomberg Television or subscribe to Yahoo Finance? It has to be entertaining. And so that's one negative, is the entertainment. The other is shock value. So if I come out today and I say, 2025 is here, so I believe it's going to be more of the same. We can expect a 5% return on the S&P 500, whatever. That's boring.
Boring. They don't want to
hear that.
Right.
Nobody wants to hear that. Now, if I come out and say the market's going to crash 30%.
Right. All of a sudden you get some more TV time.
Yes. And so it's sensationalism, I guess is the word. But I don't really know how to have someone cut through it. My interns, I will give them some specific names of people that you pay attention to this person because they know what they're talking about.
Yeah.
Are they going to be right all the time? No one's right all the time. but have a basis, have an education, have experience, and make sure that they're altruistic in their advice. They're trying to help you, not sell you something.
Right, I think that's a good point. And with all the information that is out there, you can quickly become, quickly have paralysis by analysis, right? You can quickly become paralyzed and not do anything because you're maybe afraid of making a mistake, or you're always trying to chase the next great thing that you heard of. And to give you an example, there was a client that we had the other day, 35-year-old client, called in and said, hey, how many dividend paying stocks do I have in my portfolio? Because they had read something somewhere or got on TikTok, and dividend paying stocks was the only way to build wealth. The reality is that we met with this client a little less than a year ago, and that her objective is nothing to do with income, everything to do with growth. So from a tax standpoint, why do you want to have dividend income that you have to pay taxes on whenever you can have a more growth-oriented portfolio that saves you in taxes? So it's one of those things to me where it's like it makes sense to have a personal relationship with a financial firm, with an advisory firm that has your best interest at heart, because they will help you cut through all of the noise, which to me makes our profession a very valuable profession, given even more so all the information that is out there. Some people will believe that they can DIY, but they'll make a lot of mistakes along the way. And a profession like ours and advisors like us and at our firm, we're more inclined to be able to help people cut through that noise and actually do what's best for them, and help them align their investments with their objectives, as opposed to just chasing the next fad.
Yeah, we're on the same wavelength here. You're a financial planner, is what I like to refer to you as, and I'm an investment manager. And both of these things, we're human beings, and we're interacting with real people, and we're trying to help them through our experience. And at some point, AI is going to take over, but it's going to be quite a while.
Yeah. So speaking of AI and speaking of fads, is AI a fad, or is it here to stay? And what implication does that have on investment management in our portfolios?
Well, this is just my opinion. I'm not an AI expert, but when I think back in investment management, and this will also pertain to financial planning, is investment managers tend to be nerds. We tend to be numbers nerds. And so AI, the iteration before this, was algorithms. So very complex mathematical problems that managers would build to help them make investment decisions and build portfolios. And this is not a new thing. So the most famous, in my mind, is long-term capital management, 1998. So there are a couple of Nobel laureates who built an algorithm to help them build stock portfolios. And it was working great until it didn't work great. And it collapsed so spectacularly that it almost brought down the entire world. And the Fed had to intervene and bail them out. And it crashed the markets around the world. Now, this was back in 1998. So that's 27 years ago.
Yeah.
So they're going to continue to try to build computers that can do this. And the challenge is that at the end of the day, you're trying to predict human behavior, because I can analyze a business, I can analyze financial statements, and you can build a computer program that can do that. But it's not a science, it's an art, it's a blend. And so AI, that is where they're going to run into trouble, is when AI has to interact with human beings. So in financial planning, I assume you're sitting down with somebody and they're telling you something, but you can tell that they're maybe telling you what you want to hear.
Right. It's, I've sat down with enough clients to know that sometimes clients will say that this is their priority, right? My priority is to send my kids to college. That is my number one priority. Well, how much money have you saved to send your 10-year-old to college? Zero. So is this a brand new priority, or has it always been a priority? So their actions and what they're saying, they don't align. So I think that's part of it. So I'm of the belief that AI is here to stay, right? AI is not going anywhere. The objective is going to be increase the efficiency of our everyday lives, and professionally, personally. The fastest growing segment of artificial intelligence does have to do with the emotional aspect of it. So there's already artificial intelligence that are a companion, if you will. And so a lot of the money is flowing into that. And a lot of clients, they're going to ask, and already have been asking, how can they get a piece of this because of that fear of missing out, right? They don't want to miss the next great .com bubble or the .com run up or the invention of the internet. And for a lot of people, this feels like Internet 3.0, and they don't want to miss out on it. So if someone is wanting exposure, where do they go for this exposure?
That's an interesting question. I don't know if we should go into the last several years of what's been going on in the stock market, but there are a group of stocks that are referred to by different names, the Magnificent Seven, and now it's going to become Batman. And these are large cap tech stocks that have dominated the stock market, and they've actually skewed some of the returns. And the reason that they've done so well is they're able to grow their earnings. And maybe later we'll talk about that boring subject of what drives stock prices. But to your point, these stocks are producing a lot of earnings, and they're producing a lot of cash flow. This is actually free cash flow, which they are then reinvesting in development of AI.
Okay.
So this is different from the late 90s, the tech bubble, if people remember that. So back then the internet was in its infancy, and everybody wanted a piece of the internet. They knew it was the next great thing, but they didn't know how to take advantage of it, how to profit from it. And so companies would come out, and they knew this, so they would come out and put .com at the end of their name. So if a famous one was pet.com, they're going to sell pet supplies, but it's .com, so it's high tech.
Right.
And so people would bid the price up to
Right.
just crazy levels. And one of the big differences between then and now is back then, a lot of these companies, they had an idea, they had a concept, they could come public, they could raise a lot of money, and their stock price would go crazy, but they didn't have earnings, or they didn't have real cash flow. Today, the leaders in AI are the Magnificent Seven and maybe some other companies, Broadcom, etc. These companies have real earnings, and they have real cash flow. So the best way to participate has been in the Mag 7. Now, some clients, they want to take a more risk. They're like, oh, I want to know the next Apple before anybody else. And there are funds out there, mutual funds, Kathy Wood's ARK, A-R-K funds. They're a big believer in that. And the issue with that is there's always positives and negatives to everything. So the positive is if she gets it right and you're in one of her funds, you're going to do great. The drawback is the probability of picking the next Apple or Microsoft is infinitesimal.
Right. Very small.
Very small. There are a lot of startups. They have an idea. They raise some money. They start building a concept. And at some point, they will fail. They know this, so they take their idea and their process, and they go to somebody that has money. And that's where Google and Amazon and NVIDIA, they sit back with their massive cash flows.
Yeah,
and
huge balance sheet too.
Huge balance sheets. And they say, I'll pay you $100 a share, and you come to work for me.
Right. Yeah.
Now I own the research that you've done, and more importantly, you're going to work here with me.
Yeah, they got the talent.
They've got the talent, and they just add to the talent. So that's the way that it is right now. And believe it or not, those stocks are expensive, but not relative to their earnings, their cash flow, their potential. So Tesla is in Batman, one of the new leaders in the stock market. And they have been, but Tesla is a different, we'll set that aside for now. Elon Musk wants to be in AI. He's been at the forefront of autonomous vehicles.
Right.
But their stock is extremely expensive. It's an outlier. So we'll move on from
Yeah, well, you mentioned Elon Musk, and when you mention Elon Musk, I automatically think of Donald Trump. When I think of Donald Trump, I think he's now the 47th president of the United States, and he's getting sworn into office pretty soon. There are many people that are very optimistic of what a Trump presidency looks like in respect to how their portfolios are going to perform. And there's other folks that are not as optimistic because maybe they're not a fan, or they're unsure of his policies or the tariffs that he's going to institute. What would you say to kind of the general audience of, regardless of who the president is in office, should we be investing in the market?
We had an event back before this last election. I want to say Wine and Wisdom, but it wasn't Wine and Wisdom.
Yeah, it was an election themed event.
Election
yeah,
themed.
It was red, white, and brew.
There you go, red, white, and brew. So I went back and researched the last 150 years, and what I found was very boring, which is if it's Democrat or if it's Republican in office, the market does the same over time. Matter of fact, the only time you lose money is if you only are in during a Republican or only in during a Democrat. You need to stay invested in the stock market. Now, Republicans have a reputation of being very much focused on business. They're pro-business. They're hands-off, and so that's good for business. And leading up, when the markets believed Trump was going to win, the market rallied. Then it was official. It really rallied, and it was because of basically maybe reducing regulations in the banking sector, and maybe just less oversight. So M&A activity could resume. But what's interesting is this time, excuse me, President Trump has talked about tariffs. And I believe that it's a negotiating tool, because in economics, tariffs are bad for business. If you're an American steelmaker, a tariff is good because it protects you. It allows you to raise the price of your product. But it's bad for the American consumer, because now I'm not paying for the cheapest steel which may come from China or wherever. Now I have to buy American steel. So as far as inflation, tariffs are inflationary.
Right.
So we'll see what happens with that. Also, he's talking about tax cuts and budget cuts, which we need longer term. In the short term, again, those are inflationary. But overall, I'm very positive on the market.
Yeah. So positive on the market. If a different president would have won, would you still be positive on the market?
Yes. Kamala Harris, she had some theories that were very anti-business, but having been through this so many times, a lot of it is rhetoric. Mm-hmm. It's just they're talking to get votes, and there's no way they're going to get this through Congress, especially as close as our Congress has been in the last 20 years.
Right.
There's one seat this way or that way. So talking about price controls, that's never going to happen.
Right.
So it didn't really worry me as much as some people.
Right.
Who really wanted to cash out the portfolio.
Right.
Just in case.
Right.
And that's always a mistake.
Well, okay, so yeah, that's a good segue. So one of the things that you have always said from the very moment that I met you was that it doesn't matter who's in office, companies find a way to make money. Apple's going to find a way to make money regardless of who the president is. all the other corporations, they find a way because that's their job, right? Their job is to find a way to make money, make profits, and pass those profits down to their shareholders. Right. So with that said, what makes a good company to invest in regards to strong profitability, consistent earnings? What are the things that you look for that say, this is tried and true? We can cut through all the other noise, and if we just stick to this, most clients, most folks will do all right.
Okay, I'm going to try, it's got a couple of different layers, so you have to bring me back.
Yeah.
If I don't address that specific. But going back, so we're in a capitalistic society, and so business is king, and business depends on consumers. So our economy is 2/3 the consumer. So we want people to buy things, to use things, to go on trips. And businesses know this, so they want to supply them with that. And government, for the most part, is supposed to stay out of the way, maybe protect the consumer a little bit. So at the end of the day, the CEO, the corporations, they're going to try to maximize their share price. And to do that, they need to maximize earnings, they need to maximize cash flow. To do that, you have to sell products and services. So when the government throws up a roadblock, a tariff, a regulation, they're going to try to get around that the best of their ability legally. Okay, so also we won't get off into this tangent of who do the politicians work for.
Right.
Is it the people or is it the corporations?
Right, yeah, that's a different segment.
That's a different segment. It's a whole nother podcast.
Right.
So as the beauty of our capitalism is we're able to invest in our corporations through stocks. Mm-hmm. Bonds are really the debt. We can buy the debt of companies, but to be a part of the ownership, we can actually buy stocks. And that gives us an ownership in a company like an NVIDIA.
Right.
So when you look at a company, one thing we look at as Centric is we want to be part of an owner of a corporation that looks out for the stakeholders. And so I didn't say shareholders. In business school, they tell you that the aim of a corporation is to maximize shareholder value. And I think hopefully we're evolving from that because a shareholder is simply an owner. But I say stakeholder because a stakeholder includes not only the shareholder, but the consumer and the community and the nation and the environment
and their employees.
And their employees.
Yeah. Over
time, if I come out with something right now that makes people feel good, I'm going to sell a lot of them.
Right.
But if I'm taking advantage of them, or I have externalities like I'm creating a lot of pollution, it's not a viable long-term business.
Right.
Right. So to be viable long-term, you have to look out for your stakeholders.
Yeah.
So we look for companies that have a record of very good returns for their stakeholders. They treat their employees well. They're a good place to work, and they're very profitable, and they have profit year in, year out.
Yeah.
So that's what a lot of people say they look for, but, and this is off on another tangent. So,
well, I think most companies would say that's what they look for, right? They want to take care of everyone. And I do like the idea of us moving to a society that is creating that win-win for everyone. Because if you're only winning for the shareholders and everyone else is losing, you're not going to have a company much longer because you'll have boycotts. And we've seen those in the past with people boycotting companies. Or you'll have the employees that leave the workforce and you won't have anyone to sell your products and services. And so it is a harmonious relationship that has to be balanced, and focusing on those companies that truly do that, I think, is very important. Some of that is the type of stuff that you would read in headlines, but what is the more analytical aspect of it that says, here is what their profits look like or their earnings look like, and if I see these things, I know that they're a good, viable candidate to invest in?
So to be a stock, I guess that maybe our audience is familiar with, we invest in publicly held companies. So these companies like NVIDIA and Google are owned, the shares are owned by the public. And to be a publicly traded company, you have to disclose information every quarter, annually. There's just a bunch of things that must be disclosed to the public. And we'll call them financial statements. We won't get into the regulatory filings, but let's say they're financial statements. They have to disclose once a quarter their balance sheet, their statement of cash flow, their income statement. And so we're able to look at what are they doing profitability wise, and how does this compare to what they did last quarter or last year or 5 years ago? Is there a trend? What are their competitors doing? So there will be, when they release these statements, there's a section at the beginning for management discussion. So the CEO will come out and say, hey, we had a great quarter, the future looks bright, whatever. But then you start getting into the numbers and you're like, oh, wait a minute, why is inventory increasing? Or why are the margins decreasing? Okay, so you have to, and this comes back to our discussion on listening to financial experts. What they say is one thing, but you really need to analyze the numbers themselves.
Right. Well, a lot of that sounds really boring.
Yes, it's very boring.
One, most people don't, have the time necessary to do that. But what I see, particularly in the younger generation, is that most people want to get rich quickly. And right now they can go on TikTok and YouTube and they will see various things that are showing them how to get rich quickly, whether that be investing in cryptocurrency or something else. But there are that subsect of individuals, whether they're in the younger generation or those nearing retirement, that are actually looking for the real keys to building wealth or the real keys to building success. They are trying to cut through the noise. Maybe they don't believe all the hype. I don't believe there is anything that you can get rich quickly. Certainly not consistently. There's always going to be the rare item that you get in at the perfect amount of time, but that's a very, very small, infinitesimal fraction of the people that are trying to do that. Whether that be you want to be a professional athlete, very, very small. You want to be the next great cryptocurrency and pick the next great coin, very, very small, right? Pick the next Microsoft, you already said it, very, very small. What are the things, like if we're giving advice to a general audience or even someone that comes into the office, what should they be doing that is going to help them build wealth, and not in a get rich quick type of way, but just, hey, we know for certainty if you do these things, you can actually build wealth?
Well, this is, in our vernacular, right, this is investing. This is where you own something and you're going to own it for the foreseeable future.
Yeah.
Okay? So people are enamored with speculating or gambling or trading.
Right, yeah.
And these are all short-term in nature.
Yeah.
So I remember the .com era. I like to tell stories, sometimes get off on tangents, but I remember going somewhere in a strip center here in Houston, and it said day trading. And so I walked in, and this is before a lot of people had computers in their homes. And so somebody had opened a day trading center in a strip center. Mm-hmm. And I walked in, there were computers everywhere, IBMs, and they had monitors, one monitor, and they had a giant monitor. And these people were trading all day long, buying and selling stocks, trying to get rich. Mm-hmm. And for a certain amount of time, it was very easy because, as I said before, anything that said .com was going up.
Right.
So you simply buy it and then it would go up.
Right.
You didn't know what you were buying and you didn't know why it was going up. You just knew it was going up,
Yeah.
which reminds me of Bitcoin today, but that's a different discussion. So when it became hard, those things went out of business. And then we saw, history always repeats itself. So we saw during the pandemic, people were day trading from home.
Right.
So what I'm saying here is they don't really understand what they're buying. They're just trying basically to get lucky. If they're honest with themselves, do they understand what they're buying, why they're buying it? So an investor is, you know what you're buying, why you're buying it, what the fair value is,
Yep.
and where you think it's going to be in 5 years. Are you right all the time? No. But you have a basis. And every day you're looking at it and saying, is my thesis still good here, or do I need to move on?
Right.
So an example of that is if you have a company and we have to watch their reporting. They report their income. But there are ways to hide certain things. And so we do comparisons. And if the quality of the reported earnings start to decline, that's a red flag, and we move on.
Right.
So
Yeah, you're talking about day trading. It reminds me a lot of gambling. And I think it can be likened a lot to gambling. And it reminds me when I was much younger and I went to Vegas and I started playing roulette and I got on a streak and I was just bet black or red, and I got onto a streak and I kept hitting my numbers, kept doubling up. And this false sense of bravado goes about you. Oh, I'm a better roulette player than you. I'm a better roulette player than you. And I'm a better roulette player than you. But the reality is sometimes your colors don't come up and it all comes crashing down. And I left the table with zero.
yes.
And I think so many people that get into swing trading or day trading or cryptocurrency, that is what happens. There's always going to be an anomaly that, ran off at the roulette table 20 in a row and finally walked away.
There's gambling and there's speculating. So gambling, as you said, the thing about gambling, you know your odds. With speculating, you don't. There are no odds. So a lot of people that are day trading, it's speculation. It is the riskiest thing you can do.
Yeah, that's a good point. So for someone that is young, I would say that the keys to build wealth are, one, some sort of tried and true investment strategy, and probably more important is discipline. The discipline to cut through the noise, the discipline to stick it out, the discipline to not listen to the talking heads that say, something that would want to cause you to pull the plug on something that is tried and true. So I think it's discipline. Would you agree?
Yes, very, very much so. The benefit of youth is time. If they start out and they stick with it, they can accumulate a lot of wealth in their lifetime just because of time.
Right.
And I don't want to get too far off on a parallel, but let's talk about fantasy football. Right? When I first started playing fantasy football, I was in the late 90s. And we had to make up our own rules and we had to get the scores out of the newspapers. So fast forward now, and you can go on to Yahoo and it'll auto draft for you and fill out your team, and you may not know anything. So the reason I bring that up is with investing, now you don't have to pick individual stocks. You can perhaps do ETFs. And at least that's a basis for starting.
Right. So you don't have to know how to analyze a company. You don't have to know what their free cash flow conversion rate looks like, because there are money managers, whether it be folks like us that they can hire, or if they don't want to hire someone like us, it can be as simple as a mutual fund or an exchange traded fund, as you mentioned, that already goes out, has analysts on staff that goes and buys these companies and packages them up in a way that still allows them to play fantasy football with their friends and be competitive, because it auto sets their lineup for them.
Exactly.
And if you stick to that discipline, and if you continuously save, which is another key element of building wealth, is that the more time you have on your side, the more opportunities you have to build wealth, the more disciplined you are, and the more that you're able to actively save, the more likely it is that you're going to build long-term financial security and a nice nest egg. That's how I feel about it.
You nailed it.
All right. Let's see if I have any other questions. I guess the last thing that we can talk about as we wrap up is predictions, right? Predictions for the next 5 to 10 years. How do you see the investment management landscape or the wealth management landscape evolving?
Well, in my opinion, things change so quickly now, and you have certain variables that just spring up. But with AI, I think the larger firms are going to really lean into it because they would like to manage more money with less financial planners and less portfolio managers. So you may have one planner and one portfolio manager, and you have AI. So you get clients in and let AI build a financial plan for them, let AI manage the portfolio.
Right.
So, and when times are good, there'll be no pushback.
Right. So from a consumer standpoint, how do you think most consumers would feel about that? Because for me, finance is a very emotional topic, and what I've learned over time through my childhood and all the clients that have come through the doors is that people are very emotionally tied to their money, and I still believe that most people prefer, being face to face, nose to nose with a warm body. So, do you think that there's going to be some pushback from the consumers on who they interact with?
I think right now we have two segments. We have the older generations, maybe older than 35, and they've accumulated some money, and they very much want to sit down with somebody who has experience, knows what they're doing. And then you have the people under 35 who have grown up with technology, and they're at this stage more comfortable going on their phone, Robinhood, or whatever some of these sites are to manage their money. But I think when they get to a certain stage in life and a certain place financially, they're going to need, or they're going to want the human interaction. And here at Centric, and this is what I tell people when I sit down with them, is I'm using various tools to analyze companies and build portfolios. But these are tools that we use. We don't let them make decisions. Right. So because every tool has a use and it has a weakness. And so you have to understand that. So not blindly accept whatever number it kicks out. So
Yeah, I agree with you. I think the younger generation, they do appreciate technology, and I think the older population, those that are nearing retirement, they appreciate technology a lot more than what we give them credit for, because it does ease their life. We use technology all the time, but we use it in a way that allows us to enhance the client experience and ultimately the client outcomes.
Well said.
Thanks everyone for tuning in. Hopefully there was some value that you received from today's discussion. We talked about artificial intelligence. We talked about the keys to a successful investment management strategy, how to build wealth. We'll be putting out some more segments like this and other topics in finance in the future. So we hope you tune in for those as well. Thanks for watching.